Today, we're going to dive into a massive idea in economics. It's a concept for a perfect market that, let's be honest, doesn't really exist in the wild. But, and this is a big but, it's the key to understanding every real market you deal with every single day. We are talking about perfect competition. But first, just take a second and imagine. What would a perfect market look like for you as a customer? I'm guessing it would mean tons of choices, the quality is the same no matter where you go, and of course, super low prices, right? Well, you've just hit the nail on the head. That's pretty much what economists are talking about.
So here's our game plan. First, we'll nail down what this ideal market even is. Then we'll cover the 5 rules that make it tick. After that, we'll see how it all works, look at the problems, and finally get to why this theory is so incredibly important for understanding the real world.
Okay, let's get right into it. Part 1. What in the world is a perfect market, anyway, at least according to an economist?
Here's the official definition. It's a market where you have tons of buyers and tons of sellers. They're all trading products that are completely identical. And here's the most important part. No single company, no matter how big, has any power to influence the market price.
To make this less abstract, let's use an example we're going to keep coming back to. Farming. Picture thousands of different farmers all growing the exact same kind of wheat. Now, what do you think would happen if one farmer tried to charge more than everybody else? You just buy from the farmer next door, right? That one farmer has absolutely zero control over the price.
And that leads us to this really crucial concept. In a perfectly competitive market, all the companies are called price takers. They don't make the price, the market does. All they can do is look at the price that's set by the total supply and demand and decide if they can turn a profit by taking that price.
So, what does it take to create this world of price takers? Well, that brings us to the blueprint for a perfect market. There are 5 essential rules.
For this perfect market to even theoretically exist, 5 things have to be true. 1, a huge number of buyers and sellers, so nobody has the upper hand. 2, identical products. A ton of wheat is a ton of wheat. There are no brand names or fancy labels. 3, perfect information. This means everybody knows all the prices and all the quality all the time. 4, no barriers to entry or exit. This one's huge. It means anyone can decide to start a farm and just as easily decide to close up shop. And finally, 5, perfect resource mobility. Workers and equipment can just pack up and move to wherever they're needed most without any friction.
Okay, so we've got the rules. Now let's see how these rules fire up this kind of self-correcting economic machine, one that's always pushing toward maximum efficiency.
Like we said, one farmer doesn't pick the price. It's set by the collective tug-of-war between all the farmers and all the buyers. For any single farmer, it means they can sell as much wheat as they want at the going market price. But if they try to charge even a tiny bit more, poof, their sales drop to zero.
Let's put a real number on this. Let's say the market price for wheat is 200 pounds a ton. Well, that's it. That is the price. Every farmer has to sell for 200 pounds. If one tries to sell for 210, they'll sell nothing. If they sell for 190, well, they're just giving away free money.
Okay, so what happens if suddenly everyone starts baking bread and the demand for wheat skyrockets, pushing the price up to 250 pounds? Well, for a while, the existing farmers are going to be making a killing. Economists call this supernormal profit. It's way more than they need to just stay in business. And that profit acts like a giant, flashing neon sign to everybody on the outside. Because remember, there are no barriers to entry. So new people see those huge profits and think, hey, I can grow wheat. They jump in and start new farms. As all these new farms start churning out wheat, the total supply on the market goes up. And what happens when supply goes up? You got it. The price starts getting pushed back down. And this just keeps happening until the price drops back down to a sweet spot, a point where farmers are only making normal profit, just enough to cover their costs and make it worth their time, but not enough to make anyone else want to join the party. The market has found its balance. It regulates itself perfectly. And a final result of this beautiful self-correcting dance is what economists consider the holy grail, allocative efficiency. It's a fancy term, but it means something really simple and powerful. As a society, we're using our resources to make exactly the stuff people want at the lowest possible cost. It's the best-case scenario for consumers. It all sounds fantastic, doesn't it? Super efficient, low prices for us. So why isn't every market like this? Well, this is where we run into the problem with perfection. So here's the big trade-off.
On the one hand, the advantages are incredible for us, the consumers. We get low prices, high efficiency, the market basically gives us exactly what we want. But on the other hand, the disadvantages are pretty stark. If you're a company and you know your product has to be identical to everyone else's, and you can only ever make just enough money to get by, why would you ever spend millions to innovate? There's just no incentive. And besides, those 5 conditions we talked about, perfect information, no barriers, they're just not realistic in most real-world industries.
So, you might be thinking, okay, if this thing basically never exists in the real world, why on earth do we care about it? And that's a fair question. And it leads us to the most important reason this theory matters.
See, its value isn't as a photograph of reality. Its value is as a benchmark, a yardstick. Economists use this perfect theoretical model to measure and analyze all the messy, imperfect markets we actually live in.
So how does that work in practice? It's all about comparison. Let's put our wheat farmer next to a monopoly, like the only water company in your town. The farmer is a price taker. The water company is a price maker. The farming market is super efficient. The monopoly is not. And the result for you, the consumer? Your well-being is high in the competitive market and a lot lower in the monopolistic one. By seeing how far a real market is from that perfect ideal, we can see how much power a company really has and how that's affecting all of us.
So, let's boil it all down. What's the bottom line here? Perfect competition is this ideal model where tons of sellers with identical products are all price takers. The whole system automatically self-regulates, pushing profits down to the bare minimum over time. And its real power? It's not that it exists, it's that it gives us this essential benchmark to measure every other real-world market against.
And that leaves us with one last big question to think about. If this model really is the peak of efficiency and the best deal for consumers, should governments be doing more to create them? Should they be trying to break up big companies to force markets to look more like this ideal? And what kind of unintended problems might that cause? It's something to chew on.